Just few words on the institutional aspects. Monetary policy is conducted by the Federal Open Market Committee, which meets in Washington 8 times a year. During the crisis, it sometimes also held video conferences. When we have a meeting of the FOMC, there are 19 people sitting around the table. There are the 7 members of the Board of Governors who are appointed by the President and confirmed by the Senate. And then there are the 12 presidents of the 12 Federal Reserve Banks, each of whom is appointed by the Board of Directors of that regional bank and then confirmed by the Board of Governors in Washington. So there are 19 people around the table. We all participate in the monetary policy discussion. When it comes time to vote, the system is a little bit more complicated. At any given meeting, only 12 people are able to vote. The 7 members of the Board of Governors have a permanent vote at every meeting. The president of the New York Federal Reserve Bank also has a permanent vote. Why capital B here? Which goes back to the beginning of the system and the fact that New York remains the financial capital of the United States. For the other 4 votes, there is a rotation system. Each year, 4 of the 11 other Reserve Bank presidents vote, and then the next year, a different set of 4 vote. So again, there is a total of 12 votes in any given meeting or on any given decision on monetary policy, but the entire group participates in the discussions. Figure 30 shows the federal funds rate, the short-term interest rate that is a normal primary tool the Fed uses for monetary policy. You can see that at the end of Chairman Greenspan's term and the beginning of my term in 2006, we were in the process of raising the federal funds rate in an attempt to normalize monetary policy after having easier policy earlier in the decade in order to help the economy recover from the 2001 recession. But in 2007, as problems began to appear in the subprime mortgage market, the Fed began to cut interest rates. You can see on the right side of the graph that interest rates were sharply reduced. And by December 2008, the federal funds rate was reduced to a range of between 0 and 25 basis points. A basis point is 100th of 1%, so 25 basis points means 1/4 of 1%. By December 2008, the federal funds rate was reduced basically to 0. It cannot be cut anymore, obviously. So as of December 2008, conventional monetary policy was exhausted. We could not cut the federal funds rate any further, and yet the economy clearly needed additional support. Into 2009, the economy was still contracting at a rapid rate. We needed something else to support recovery, and so we turned to less conventional monetary policy. The main tool we have used is what we in the Fed call the large-scale asset purchases, or LSAPs, known in the press and elsewhere as quantitative easing, or QE. These large-scale asset purchases were an alternative way of easing monetary policy to provide support to the economy. So how does this work? To influence long-term rates, the Fed began to undertake large-scale purchases of treasuries and government-sponsored enterprises mortgage-rated securities. So just to be clear here, the securities that the Fed has been purchasing are government guaranteed government guaranteed securities, either treasury securities, that is government debt of the United States, or Fannie and Freddie securities, which were guaranteed by the US government after Fannie and Freddie were taken into conservatorship. There have been two major rounds of large scale asset purchases, one announced in March 2008, often known as QE1, and another announced in November 2010, known as QE2. There have been some additional variations since then, including a program to lengthen the maturity of our existing assets, but these were the two biggest programs in terms of their size and their impact on the Fed's balance sheet. Taken together, these actions increased the Fed's balance sheet by more than $2 trillion. Figure 31 shows the asset side of the Fed's balance sheet to help us see the effects of the large-scale asset purchases. The bottom layer is the traditional securities holdings. To be absolutely clear, even under normal circumstances, the Fed always owns a substantial amount of Treasury securities. We owned more than $800 billion worth of US Treasuries before the crisis began. It is not as though we began buying them from scratch. We have always owned a significant amount of these securities. So the bottom layer shows the baseline from which we started. What else appeared in the Fed balance sheet on the assets side during this period? The dark segment just above the traditional securities holdings represent assets acquired or loans made during the crisis period. You can see that in late 2008, our loans outstanding to financial institutions and to some other programs rose very sharply. But you can also see that as time passed, and certainly by early 2010, those initiatives to address financial strength had been greatly reduced. If you look at the far right, you see a little bump recently. That is the currency swaps. We instituted and extended swap agreements with the European Central Bank and other major central banks. And there has been some uses of that in an attempt to try to reduce strains in Europe. And that shows up as a little bump that at the far right of the graph. Now, again, we owned about $800 billion in Treasury securities. At the beginning of the crisis, but as you can see from the large area labeled LSAT, we added about $2 trillion in new securities to the balance sheet during the period starting in early 2009. And then at the top, you have other assets, a variety of things, security reserves, physical assets, and other miscellaneous items. Why were we buying these securities? This is, by the way, an approach that monetarists such as Milton Friedman and others have talked about. The basic idea is that when you buy treasuries or government-sponsored enterprise securities and bring them onto the balance sheet, bring them onto the balance sheet, that reduces the available supply of those securities in the market. Investors want to hold these securities and they have to settle for a lower yield or a higher price. Or put another way, if there is a smaller available supply of those securities in the market, investors are willing to pay a higher price for those securities, which is the inverse of the yield. So by purchasing treasury securities, bringing them onto our balance sheet and reducing the available supply of those securities, we have effectively lowered the interest rate of longer term treasuries and government-sponsored enterprise securities as well. Moreover, to the extent that investors no longer having available treasuries and government-sponsored enterprise securities to hold in their portfolios to the extent that they are induced to move to other kinds of securities, such as corporate bonds, that also raises the prices and lowers the yield on those securities. And so the net effect of these actions was to lower yields across a range of securities. And as usual, lower interest rates have supportive, stimulative effects on the economy. So this was really a monetary policy by another name. Instead of focusing on the short-term rate, we were focusing on longer-term rates. But the basic logic of lowering rates to stimulate the economy is really the same. You might ask, the Fed is buying $2 trillion worth of securities. How do we pay for that? The answer is that we paid for those securities by crediting the bank account of the people who sold them to us. And those accounts at the bank showed up as reserves that the banks would hold with the Fed. So the Fed is a bank for the banks. Banks can hold deposit accounts with the Fed, essentially, and those are called reserve accounts. And so, as the purchases of securities occurred, the way we paid for them was basically by increasing the amount of reserves that banks had in their account with the Fed. They basically sit there. They are not in circulation. They are not part of any broad measure of my supply. They are part of what is called monetary base, but they certainly not cash. Then the top layer, sure.